Bond market vs. Stock market. What's the difference? Bond market vs. Stock market. An overview. It's time to invest your money. So how exactly are you going to allocate that money? After all, a well-diversified portfolio strategy is recommended before you start to buy assets such as stocks and bonds. Indeed, stocks and bonds are two of the most traded types of assets, each available for sale on several different platforms or through a variety of markets or brokers. And there are important primary differences between stocks and bonds. Key takeaways. A stock market is a place where investors go to trade equity securities, e.g., shares, issued by corporations. The bond market is where investors go to buy and sell debt securities issued by corporations or governments. Stocks typically trade on various exchanges, while bonds are mainly sold over the counter rather than in a centralized location. In the United States, the prominent stock exchanges include NASDAQ and the New York Stock Exchange, NYSE. What is the difference between the bond market and the stock market? The bond market. The bond market is where investors go to trade, buy and sell debt securities, prominently bonds, which may be issued by corporations or governments. The bond market is also known as the debt or the credit market. Securities sold on the bond market are all various forms of debt. By buying a bond, credit, or debt security, you are lending money for a set period and charging interest, the same way a bank does to its debtors. The bond market provides investors with a steady, albeit nominal, source of regular income. In some cases, such as treasury bonds issued by the federal government, investors receive biannual interest payments. 1. Many investors choose to hold bonds in their portfolios as a way to save for retirement, for their children's education, or other long-term needs. Investors have a wide range of research and analysis tools to get more information on bonds. Investopedia is one source, breaking down the basics of the market and the different types of securities available. Other resources include Yahoo, Finance's Bond Center, and Morningstar. They provide up-to-date data, news, analysis, and research. Investors can also get more specific details about bond offerings through their brokerage account. A mortgage bond is a type of security backed by pooled mortgages, paying interest to the holder monthly, quarterly, or semi-annually, where bonds are traded. The bond market does not have a centralized location to trade, meaning bonds mainly sell over the counter, OTRA. As such, individual investors do not typically participate in the bond market. 2. Those who do include large institutional investors like pension funds, foundations, and endowments, as well as investment banks, hedge funds, and asset management firms. Individual investors who wish to invest in bonds may do so through a bond fund managed by an asset manager. Many brokerages now also allow individual investors direct access to corporate bond issues, treasuries, munis, and CDs. New securities are put up for sale on the primary market, and any subsequent trading takes place on the secondary market, where investors buy and sell securities they already own. These fixed income securities range from bonds to bills to notes. By providing these securities on the bond market, issuers can get the funding they need for projects or other expenses needed. For investors without access directly to bond markets, you can still get access to bonds through bond-focused mutual funds and ETFs. Who participates in the bond market? The three main groups involved in the bond market include issuers. These are the entities that develop, register, and sell instruments on the bond market, whether they're corporations or different levels of government. For example, the U.S. Treasury issues treasury bonds, which are long-term securities that provide biannual interest payments for investors and mature after 10 years. 1. Investing in certain sectors of the bond market, such as U.S. Treasury securities, is said to be less risky than investing in stock markets, which are prone to greater volatility. Underwriters. Underwriters usually evaluate risks in the financial world. In the bond market, an underwriter buys securities from the issuers and resells them for a profit. Participants. These entities buy and sell bonds and other related securities. By buying bonds, the participant issues a loan for the length of the security and receives interest in return. Once it matures, the face value of the bond is paid back to the participant. Bond rating. Bonds are normally given an investment grade by a bond rating agency like Standard & Poor's and Moody's. This rating, expressed through a letter grade, tells investors how much risk a bond has of defaulting. A bond with AIA or a rating is high quality, while an A or BB rated bond is medium risk. Bonds with a BB rating or lower are considered to be high risk. 4. The stock market. A stock market is a place where investors go to trade equity securities, such as common stocks and derivatives, including options and futures. Stocks are traded on stock exchanges. Buying equity securities or stocks means you are buying a very small ownership stake in a company. While bondholders lend money with interest, equity holders purchase small stakes in companies on the belief that the company performs well and the value of the shares purchased will increase. The primary function of the stock market is to bring buyers and sellers together into a fair, regulated, and controlled environment where they can execute their trades. This gives those involved the confidence that trading is done with transparency and that pricing is fair and honest. This regulation not only helps investors, but also the corporations whose securities are being traded. The economy thrives when the stock market maintains its robustness and overall health. Just like the bond market, there are two components to the stock market. The primary market is reserved for first-run equities. Initial public offerings, IPOs, will be issued on this market. This market is facilitated by underwriters who set the initial price for securities. Equities are then opened up on the secondary market, which is where the most trading activity takes place. 5. The number of securities that first started trading on the New York Stock Exchange on May 17, 1792, the first day of trading. 5. The prominent U.S. stock exchanges. In the United States, the prominent stock exchanges include NASDAQ, a global electronic exchange that lists the securities of smaller capitalization companies from different parts of the world. Although technology and financial stock make up the bulk of the index, it also includes consumer goods and services, healthcare, and utilities. This exchange also forms the basis of the U.S. Technology Sector Benchmark Index. 6. New York Stock Exchange, NYSE, is the largest exchange in the world based on the total market cap of its listed securities. Most of the oldest and largest publicly traded companies are listed on the NYSE. The NYSE has gone through a series of mergers and was most recently purchased by the Intercontinental Exchange, ICE, in 2013. 7. 30 of the largest companies on the NYSE make up the Dow Jones Industrial Average, DJIA, which is one of the oldest and most watched indexes in the world. 8. American Stock Exchange, AMEX, which was acquired by the NYSE Euronext and became the NYSE American in 2017. 9. 10. It was first known for trading and introducing new products and asset classes. The exchange was also the first to introduce an ETF. Operating electronically, the exchange is home to mostly small cap stocks. These markets are regulated by the U.S. Securities and Exchange Commission, SEC. 11. Key differences. One major difference between the bond and stock markets is that the stock market has central places or exchanges where stocks are bought and sold. The other key difference between the stock and bond market is the risk involved in investing in each. When it comes to stocks, investors may be exposed to risks such as country or geopolitical risk, based on where a company does business or is based, currency risk, liquidity risk, or even interest rate risks, which can affect a company's debt, the cash it has on hand, and its bottom line. Bonds, on the other hand, are more susceptible to risks such as inflation and interest rates. When interest rates rise, bond prices tend to fall. If interest rates are high and you need to sell your bond before it matures, you may end up getting less than the purchase price. If you buy a bond from a company that isn't financially sound, you're opening yourself up to credit risk. In a case like this, the bond issuer isn't able to make the interest payments, leaving itself open to default. Stock market performance can broadly be gauged using indexes such as the S&P 500 or Dow Jones Industrial Average. Similarly, bond indices like the Barclays Capital Aggregate Bond Index can help investors track the performance of bond portfolio. The difference between equity markets and fixed income markets. Equity markets vs. Fixed income markets. An overview. The major differences between equity and fixed income markets are the types of securities traded, the accessibility of the markets, the levels of risk, the expected returns, the goals of investors, and the strategies used by market participants. Stock trading dominates equity markets, while bonds are the most common securities in fixed income markets. Individual investors often have better access to equity markets than fixed income markets. Equity markets offer higher expected returns than fixed income markets, but they also carry higher risk. Equity market investors are typically more interested in capital appreciation and pursue more aggressive strategies than fixed income market investors. Key takeaways. The major differences between equity and fixed income markets are the types of securities traded, the accessibility of the markets, the levels of risk, the expected returns, the goals of investors, and the strategies used by market participants. All equity markets, no matter the type, can be volatile and experience significant price highs and lows. Due to the lower risks and rewards, strategies are often far less varied in fixed income markets than equity markets. The growth of exchange-traded funds, ETFs, has transformed equity and fixed income markets while blurring the lines between them. Equity markets. Equity markets involve the purchases and sales of stocks conducted on regular trading exchanges. Investors obtain partial ownership of corporations in equity markets while bonds are solely interest-earning investments. The Nasdaq and the New York Stock Exchange, NYSE, are among the best-known equity markets. All stock markets, no matter the type, can be volatile and experience significant price highs and lows. In equity markets, the shares of individual companies are sold to the public in initial public offerings, IPOs, and continue to trade on exchanges after that. Most retail investors are comfortable buying and selling stocks in equity markets. Furthermore, many brokerages charge low or no fees for trading them. They also offer ways to trade fractional shares, so high-priced stocks are available to small investors. Equity markets are generally very accessible. The high risks and sometimes spectacular profits in equity markets led to the development of multiple strategies, such as growth investing and value investing. A high degree of success in equity markets usually requires greater amounts of research and follow-up on investments than is necessary for fixed income investments. There are also widely divergent approaches to trading in equity markets, from high-frequency trading to buy and hold. Some traders in equity markets try to enhance gains by using leverage, while others try to reduce risks by hedging. Beating equity markets is hard rather than easy, so many investors are better off with index funds. Fixed income markets. The fixed income market is more commonly referred to as the debt securities market or the bond market. It consists of bond securities issued by the federal government, corporate bonds, municipal bonds, and mortgage debt instruments. The bond market is referred to as a capital market since it provides capital financing for long-term investments. Debt security investments are generally seen as less risky than equity investments. As such, they typically offer lower potential returns. Debt security investments were traditionally traded over. Debt security investments were traditionally traded on exchanges. Fixed income securities are often issued at auctions, such as the U.S. Treasury Department's bill auctions. Treasury Direct is the only way that most investors directly access the fixed income market. Mutual funds are a far more common way to access corporate bonds in fixed income markets than participating in the over-the-counter market. Due to the lower risks and rewards, strategies are often far less varied in fixed income markets than equity markets. The goal is usually to assure the safety of principal by purchasing only bonds with an investment-grade credit rating. Within those narrow limits, fund managers and investors often look for higher yields. However, capital appreciation is also possible under specific scenarios. The prices of zero coupon U.S. Treasury bonds can move up substantially as interest rates fall. When distressed credit markets clear up, fallen angels sometimes return to investment-grade status and experience significant price gains in the process. Special consideration. The growth of exchange-traded funds, ETFs, has transformed equity and fixed income markets while blurring the lines between them. ETFs may hold any combination of stocks or bonds, but they trade on stock exchanges. ETFs often have reasonable prices, below $100 per share, so they are accessible to all investors. That is more important for bonds, as many small investors could not trade them so easily before. With ETFs, investors achieve instant diversification and can often determine the quality of securities by merely looking at the label. For example, an investment-grade bond ETF would be an easy way to earn more income than in a savings account with limited risk. For stocks, ETFs offer a substantial reduction in idiosyncratic risk and easier access to foreign markets. Cash fees. Bonds. What's the difference? Cash vs. bonds. An overview. With the bull market in the U.S. economy now over 10 years old and talk of a pullback, many are more concerned with protecting the money they have than with growing additional wealth. There are a number of investment vehicles touted as safe places to store savings, but many people feel nothing could ever be as safe as cash. The security of knowing exactly where your money is, such as safely stowed away in a federally insured checking or savings account, is undoubtedly appealing. 1. However, with the risk of inflation potentially rendering today's dollars significantly less valuable down the road, many low-risk, modest-reward investments continue to be popular among investors looking to put their money to work without incurring too much risk. Bonds, in particular, have long been heralded as one of the safest investments available because they guarantee the return of principal while still generating periodic interest payments. 2. Holding cash and investing in bonds are both viable options for those looking to protect their savings from a volatile market. However, it is important to understand the risk and rewards of both options to ensure you choose the investment strategy that best suits your needs. Key takeaways. Holding cash and investing in bonds are both ways for cautious investors to protect their wealth, even if the economy takes a turn for the worse. Cash is readily available and typically insured by the Federal Deposit Insurance Corporation, FDIC, for up to $250,000 per banking institution where deposits are held. 1. Cash does not earn any return in and of itself, and so inflation can erode its buying power over time. Sitting in cash also presents an opportunity cost as it forgoes potentially better investment. Bonds provide interest income that often meets or exceeds the rate of inflation, and with the potential for capital gains if bought at a discount. Bonds, however, do have some inherent risks and could lose value if the underlying issuer goes bankrupt or if interest rates rise. 2. Cash. The primary benefit of keeping your money in cash is the obvious advantage of maintaining complete control. If you simply deposit your cash into a bank or savings account, you can easily review your balance and transaction history with the click of a button, knowing that no one but you has access to those funds. In addition, checking and savings accounts at almost any bank are insured through the Federal Deposit Insurance Corporation, FDIC, for up to $250,000. 1. While banks are not required to purchase this coverage, it has become such a ubiquitous symbol of a bank's quality that any institution that is not FSD insured is not likely to do well. Accounts at federal and state chartered credit unions are also insured up to $250,000 through the National Credit Union Administration, NCU. If your savings exceed this limit, it is possible to insure all your deposits by opening multiple accounts at different institutions. 3. Another advantage of keeping cash is it provides ultimate flexibility in times of stress. If you need to access your funds in the near future, such as within the next 3 years, holding cash is the best way to ensure that you have the money whenever you need it. Though investing offers the possibility for profits, it can also put your funds at significant risk, meaning you may not have the money you need on short notice. Risks of cash. The biggest risk you incur when holding cash is the risk of inflation. If interest rates rise, the money you have now may have significantly less buying power in the future. This is the main reason that most investors allocate much of their cash holdings to cash, equivalent money market accounts, or mutual funds. Though these types of highly liquid investments generate only a modest amount of interest, it can be enough to offset the effects of inflation over time. 4. The other disadvantage of holding cash is it carries a significant opportunity cost. Opportunity cost refers to the forfeiture of potential profits that could have been generated had you used your money in a different way. Since holding cash effectively generates zero profit, the opportunity cost of this strategy can be quite high. This is known as cash drag in a portfolio. Given all the different investments available that generate guaranteed income, such as bonds and certificates of deposit, DIUs, holding cash means you might be giving up the opportunity to reap significant return. 5. 2. Both cash and bonds are vulnerable to rising interest rates. Higher rates sap the cash from some of its buying power and lower the value of the bond. Bonds. Unlike holding cash, investing in bonds offers the benefit of consistent investment income. Bonds are debt instruments issued by governments and corporations that guarantee a set amount of interest each year. Investing in bonds is tantamount to making a loan in the amount of the bond to the issuing entity. 2. In exchange for this loan, the issuing company or government pays the bondholder monthly, quarterly, semi-annual, or annual coupon payments equal to a set percentage of the bond's par value. The income generated by bond investments is stable and predictable, making them popular investments for those looking to generate regular income. 2. Once a bond matures, the issuing entity pays the bondholder the par value of the bond, regardless of its original purchase price. Investing in bonds offers the potential for capital gains if a bond is purchased at a discount, as well as interest income. 2. Bond risk. Bonds carry varying degrees of risk depending on their maturities, which can range from a few months to several decades, and the credit rating of the issuing entity. Investors can choose which type of bonds to invest in based on their goals and risk tolerance. In times of economic instability, bonds and other debt instruments issued by the U.S. Treasury are considered extremely safe because the risk of the U.S. government defaulting on its financial obligations is minimal. 6. Similarly, bonds issued by very highly rated U.S. corporations are typically very low-risk investments. 7. Of course, the interest rates paid on these high-quality bonds are often lower than those paid on junk bonds or other risky investments, but their stability may be worth the trade-off. In addition, bonds issued by state and local governments are typically not subject to federal income taxes, making them one of the more tax-efficient investments available. 8. Key differences. The biggest difference between bonds and cash are that bonds are investments while cash is simply money itself. Cash, therefore, is prone to lose its buying power due to inflation, but is also at zero risk of losing its nominal value, and is the most liquid asset there is. The primary risk of bond investing is your investment loses value. If an issuing entity defaults, you may lose some or all of your investment. 2. While bondholders have a higher claim on company assets than stockholders, the likelihood of receiving the full value of your bond after a company declares bankruptcy is low, since it likely must first pay off its loans, mortgages, and other debts. 9. Your bond may also lose value if rising interest rates render it worthless on the secondary market. If new bonds are issued with higher coupon rates, the market value of your bond declines. However, this is only a concern if you are looking to trade your bond before maturity. If you retain your bond until it matures, you are paid its par value regardless of its current market price. 2. Unlike keeping your money in a checking or savings account, any investment in bonds is uninsured. Just like stocks or mutual funds, you voluntarily take on a certain degree of risk when you purchase bonds. Because of this, the FDIC does not insure these investments. 1. If you lose money on bond investments, there is no way to recoup your losses. However, you can largely mitigate this risk by investing in highly rated bonds and holding them until maturity. Money market Vs. Short-term bonds. What's the difference? Money market Vs. Short-term bonds. An overview. On a short-term basis, money market funds and short-term bonds are both excellent savings vehicles. Both are liquid, easily accessible, and relatively safe securities. However, these investments can involve fees, may lose value, and might decrease a person's purchasing power. Although money market funds and short-term bonds have many similarities, they also differ in several ways. Key takeaways. The money market is part of the fixed income market that specializes in short-term government debt securities that mature in less than 1 year. Buying a bond means giving the issuer a loan for a set duration. The issuer pays a predetermined interest rate at set intervals until the bond matures. Money markets are extremely low. Risk with a par value of $1 typically. Meanwhile, short-term bonds carry a greater degree of risk depending on the issuer, which may be a company, government, or agency. Money market. The money market is part of the fixed income market that specializes in short-term debt securities that mature in less than 1 year. Most money market investments often mature in 3 months or less. Because of their quick maturity dates, these are considered cash investments. Money market securities are issued by governments, financial institutions, and large corporations as promises to repay debts. They are considered extremely safe and conservative, especially during volatile times. Access to the money market is typically obtained through money market mutual funds or a money market bank account. The assets of thousands of investors are pooled to buy money market securities on the investor's behalf. Shares can be bought or sold as desired, often through check writing privileges. A minimum balance is typically required and a limited number of monthly transactions are allowed. The net asset value, NAV, typically stays around $1 per share, so only the yield fluctuates. Because of the liquidity of the money market, lower returns are realized when compared to other investments. Purchasing power is limited, especially when inflation increases. If an account drops below the minimum balance required or the number of monthly transactions is exceeded, a penalty may be assessed. With such limited returns, fees can take away much of the profit. Unless an account is opened at a bank or credit union, shares are not guaranteed by the Federal Deposit Insurance Corporation, DISC, National Credit Union Administration, NCUA, or any other agency. Short-term bonds. Bonds have much in common with money market securities. A bond is issued by a government or corporation as a promise to pay back money borrowed to finance specific projects and activities. In such cases, more money is needed than the average bank can provide, which is why organizations turn to the public for assistance. Buying a bond means giving the issuer a loan for a set duration. The issuer pays a predetermined interest rate at set intervals until the bond matures. At maturity, the issuer pays the bond's face value. A higher interest rate generally means a higher risk of complete repayment with interest. Most bonds can be bought through a full-service or discount brokerage. Government agencies sell government bonds online and deposit payments electronically. Some financial institutions also transact government securities with their clients. Short-term bonds can be relatively low risk, predictable income. Stronger returns can be realized when compared to money markets. Some bonds even come tax-free. A short-term bond offers a higher potential yield than money market funds. Bonds with quicker maturity rates are also typically less sensitive to increasing or decreasing interest rates than other securities. Buying and holding a bond until it is due means receiving the principal and interest according to the stated rate. Bonds carry more risk than money market funds. A bond's lender may not be able to make interest or principal payments on time, or the bond may be paid off early with the remaining interest payments lost. If interest rates go down, the bond may be called, paid off, and reissued at a lower rate, resulting in lost income for the bond owner. If interest rates go up, the bond owner could lose money in the sense of opportunity cost by having the money tied up in the bond rather than invested elsewhere. Special considerations. There are pros and cons to investing in money markets, funds, and short-term bonds. Money market accounts are excellent for emergency funds since account values typically remain stable or slightly increase in value. Furthermore, money is available when needed and limited transactions discourage removing funds. Short-term bonds typically yield higher interest rates than money market funds, so the potential to earn more income over time is greater. Overall, short-term bonds appear to be a better investment than money market funds.